Hello, I'm Tony Kaye. Welcome to the Economic View. I'm here today with Evan Lucas, our market strategist. Hi, Evan.
Hey, Tony, how are you?
Yeah, very good. Evan, there's a lot going on, obviously, in the Australian market, but I want to talk about what's coming out of China. We've had some figures out yesterday on imports and exports. So I just wanted to talk about that and what that means for Australia, given they're such an important influence for us.
Yeah, huge important influence. It's nice to finally get to talk to you about sort of a sort of slightly longer theme in the economic market and look at the macro side. So the trade balance yesterday was choppy. I think that's the only way to sort of explain it. Some people look at the CNY side, so the Chinese renminbi side. Some people look at it from the US dollar side. I always look at it from the US dollar side. Reason for it, it's what our products are denoted in.
Everything's priced.
Yeah, and that's so it came in at 42.8 bill. That was better than expected, but exports were flat in terms of what was expected. They didn't grow anywhere near. And I do like to highlight at the moment what China is really pointing out, which is their second and third largest trading partners on their exports is the Eurozone and Japan. And they have had a very, very weak period, particularly not this year, but last year and the year before. Very weak period. And it was a concern that Chinese exports would be a bit of a downfall with them as their second two largest markets behind the US really fell away. This year's been very, very strong. Double-digit growth. In fact, they actually hit the two handle on the double digits. So 20% varying, respectively, for the Eurozone and Japan. So really solid. Yesterday wasn't that good, unfortunately. It was a drop, but it's still growing at double digit. So there's a cushion there. You've got to look at it from the point of view that the shining light for Chinese exports was the US. Now, that probably wasn't sustainable. But having those three back in line, it is a very big positive for things like Chinese steel exports then move into imports from Australian goods. And I think that needs to be the way you look at it. If you look at Australian exports to China, it makes up roughly about a third of our overall terms of trade.
Absolutely, yeah.
What the Chinese trade balance is showing and what our trade balance is showing is being slightly backed up. It's never perfect because the Chinese have invoicing concerns, and that's all I'll probably put on that point. But it does show that our exports that have been reported to China are being backed up by the imports that they're seeing as well, and therefore Chinese exports being backed by demand from Japan, Eurozone, US, just shows that Chinese story is actually much better than was forecasted because, again, the bearish view on China is still there. A lot of people will continue to point to the debt to GDP, and this week has been case in point again that it is continuing to hit another record, hit around about 190 in terms of that ratio. So it is high, but the Chinese have really shown that they are able to manage it and manage it well, and that in this new world, infrastructure is coming on. It explains why the steel price is doing what it's doing. Demand for iron ore and therefore the steel making material is still very strong.
Yep.
And copper is what you need to look at now.
Yep. So we've seen that big pickup in the copper price, which directly translates back into China, really. In terms of
two-year high. And it's the reason everybody calls it Dr. Copper is because it is an incredible gauge of infrastructure spending and also construction and work done. Reason for it, copper is almost a necessity product in any form of construction in terms of what it does, and that's why it's such a very good needle indicator about the kind of demand for, as I said, construction, infrastructure spending, growth, materials. So to see a two-year high both on the CME and LME, so the as of last night, it was $2.90 a pound over in Chicago, and it was 6,480 a tonne on the LME in London. So the demand is there. I mean, this is a couple of years ago that copper was welded in a bear market. It was actually thinking about pushing into the $4,000 handle in the LME, and it hit as low as $1.90 a pound in Chicago. So it's a really strong story, and it's not just looking at China. It does also mean that you've got to look at it from a US perspective as well, because part of the copper story on the CME side is a US story. So that is also part of this, is that global economics are there. The metrics to look at, commodity markets, bulk commodity markets, are backing that up. So as we go through, and I know we normally talk about the macro stuff, but as we go through the micro stuff right now with Aussie earnings season, you should be able to see that translation. You should actually see, the production is definitely up. We've seen that in production numbers, but you actually see actuals backing up the kind of price movements that we've seen.
Yeah. Now, I'm not talking about mining boom here, but Right now, there's the Diggers and Dealers Conference going on down in Kalgoorlie. We've got one of our riders down there at the moment. He was saying to me yesterday that the sentiment there amongst miners is really good.
It's really positive.
It's the best it's been in years.
Yep, and you can hear that. I think, again, picking up on probably just let's look at Rio and listening to what JS Jacques said last Thursday. It's probably the first time in a while that I've actually seen Rio as an organisation a little bit more rosy on the outlook. They've always put in their outlook statement that global economics look choppy. Demand for bulk commodity prices we expect to decline. Now, that hasn't changed, but it's certainly not what they were suggesting last year and the year before, where they expected a real slowdown and that their complete mantra was to get back to an operating cost rather than being a CapEx model that had operating costs in it. It was just straight operation costs and that was it. And that's a step on the side of something that's not been seen. So that positiveness is actually going to the bigger end of town. And getting back to what we just talked about, what they are clearly concentrating on is copper.
Yeah.
And that shows you that if they are going to concentrate on picking up and sort of sucking up the price in copper at the moment, that they too realise that things are much better than probably even they forecasted. And normally the companies tend to be better than the analysts because they're obviously living and breathing it every day. So it shows that the macro and the micro are starting to align, and that's again a positive sign.
And what's also good for the miners and copper miners is that the Chinese are actually clamping down on an environmental level on stuff being dumped into China, like copper wires and things.
Exactly.
They don't want that. They actually want just the copper.
That's right, and they're clamping down on themselves too in terms of poor mining practices, and that was always again the looking at an iron ore side as well, is that the Chinese iron ore is really poor in ferrous content, and the amount of expenditure of energy required to pull it out was just not cost effective. And then the environmental side, which Beijing has taken for the first time in a long time really seriously and have clamped down quite dramatically on it, is again a positive because it means that only good quality iron ore goes into the market, same with copper, and those that are efficient at doing it are being rewarded for it. So yeah, dumping and then that recycling copper scenario is no longer happening. It also shows that the turnover and the cycle of some of their infrastructure projects is slowing down. So they were recycling infrastructure. They're actually now talking about new start infrastructure, and that's again why there's this. If you look at all the prices we're talking about are 3-month forwards, so there is demand that comes September at the expiry and then also in December expiry, that the demand is there for a reason, that's clearly a new project come on time, and that's what is coming into the actuals as well.
Yep, so lots of positives I think, and thanks for joining us again, Evan.
Thanks, Tony.
We'll see you again next time.
Did you know that your membership gives you access to InvestSMART, Intelligent Investor and Eureka Report? Just use your original login details on all 3 sites or go straight to investsmart.com.au where you'll find all of our content no matter where it's published first.